People are much more likely to believe pessimistic views about the economy than they are to believe optimistic. If I'm trying to convince you that the economy is going to do well, it seems like I'm trying to sell you on something. In fact, the investment companies and financial professionals of the world often are trying to sell you on investments. When the opposite's true and I'm trying to convince you the economy is going to do poorly, it seems like I'm doing you a favor, trying to prevent some economic tragedy. Similarly, if you act on pessimism, it leads towards safety, and if you act on optimism, it leads towards risk. In general, we prefer safety over risk, which is why we're all so much more likely to believe pessimistic views on the economy, which leads us to our first chart. This is the Fed's prediction of whether a recession is going to come in the next 4 quarters or about a year. Now, over the last 40 years, we've had about 5 recessions, if you include the one from 1982, which is about once every 8 years, or about 12.5%, which is this line here. You can see that the Fed almost universally predicts that the chance of a recession is higher than that, meaning even the experts on the U.S. economy are more pessimistic than history has shown to be true. Now, this is one of the 14 charts in the article that I'm going to go through. But before we dive into the rest of them, it's really important that we understand this pessimism versus optimism. So let's dive deeper into this chart by looking at it like this. Now the chart goes back to 1970, and you can see the 40 years that I was talking about, including the 5 recessions labeled here in these gray areas. You can also see the 3 predictions that the Fed comes up with. The blue line is whether there'll be a recession this quarter, the red line next quarter, and the orange line sometime in the next year. You can imagine that if you're in a recession, it becomes very easy to predict whether there's going to be a recession this quarter or next quarter, which is why the blue and red lines spike up so high. But I want to draw your attention back to that orange line, which is what we were looking at in the last chart. Let's put back in the 12.5% line, which was the actual likelihood that a recession was going to occur during this time. And you see that the Fed is almost universally pessimistic and predicts that there is a higher likelihood of a recession occurring. But more importantly, look at the time periods directly before all the recessions. And I don't see any evidence that the Fed has some inkling that a recession is coming over any other time. If this was your weather person, you would stop listening to them. They almost universally tell you that there is a higher likelihood of rain than there actually is. And when the rain actually comes, there was no extra forewarning compared to any other day. And this is not because I think the Fed does a bad job. In fact, I think the Fed does a remarkable job. This is because predicting anything about the economy is so incredibly difficult. So you combine this idea that we're more likely to believe pessimistic news than optimistic news, and the fact that the news is almost universally wrong because it's so difficult to predict anything around the economy, and it very deeply entrenches us in this norm where we are more likely to believe pessimistic things about the economy.
Human sacrifice, dogs and cats living together, mass hysteria.
I promised 14 charts, and this is where they're going to come from. It's an article from Morningstar, a very trusted source in the financial world. It's 14 charts financial advisors should show clients. I read through it and agreed with them. There's a lot of great information in here. Now, I'm going to pull the charts out all individually and show them, but I'll provide a link in the description to the full article if you want to read through their commentary, which is also very, very good. The first 3 charts really just show that the stock market has come back very well in 23 compared to the 22 downturn. There's 2 important takeaways here. The first is that when you're in the middle of a downturn as financial advisors, we cannot guarantee that the stock market will come back. All we can do is point to all of the stock market's history and show that every time it's gone down, it has come back. But when you're in the middle of a decline, that's not very reassuring. Now we just have one more data point when the stock market was down and it came back. The other bigger takeaway is that even when the market is doing well, the doomsdayer will use that as some evidence that it's going to be even worse in the future. It's a bubble, or it's gotten too high, meaning when it finally does come down, it'll be even worse than if it hadn't been up. Or a very commonly touted problem these days is that the market growth is not healthy because the growth has been limited to just a few stocks. This is a pitfall that I've even fallen into, and it is why the next few charts are so important. Here you can see that the largest 7 stocks in the large cap index make up about 25% of that index's valuation. And yet in 2023, they've made up for almost 80% of the returns. Presented like this, it does seem unhealthy. But to understand what's going on here, which is really a trick of measurement, we have to start understanding the next chart. Here's the total weight of the largest stocks in that same large cap index. The three lines are the largest, the top 5, and the top 10. Over the last 100 years, you can see that it's generally trended down. Over the last 40 years, the total weight has largely stayed consistent. And here in the recent past, it has spiked a little bit, which I will come back to. The question should be, if the largest stocks of an index consistently outperform that index, then why is it that their total weight isn't increasing instead of generally decreasing like it shows here in the graph? The secret is that trick in measurement I talk about, specifically that the top 10 stocks of an index change. In fact, they change a lot. The top 10 stocks in 1980 are very different than 2000 or today in 2023. Here's a great example. Here are the largest 25 stocks in the S&P 500 in 2001. Over the next 20 years, they returned 93%. But the S&P 500 returned 310% over that time. So if the largest stocks of an index are consistently outperform it, why did these do so poorly? Well, the secret is because the largest stocks of an index constantly change, with poor performers being replaced by new high-performing stocks. And each year we measure the new top stocks of an index. Here's the same list in 2021. With the stocks that appear on both lists highlighted in gray, you can see that most of the stocks have changed out, and almost all of the very top stocks have changed out. It's not that the largest stocks of an index consistently outperform it, but that by only measuring a very small percentage at the top of the index, the poor performers quickly fall out of that category and are replaced by new high-performing stocks. By only measuring 7, 10, or 25 stocks of the S&P 500, you are naturally only measuring the outliers and ignoring all the poor performers. It's really nothing more than the mathematics of how we're measuring it. But what happened over the last 5 to 7 years? It looks dramatic, and to be perfectly honest, something dramatic did occur. 3 major companies really came into this space and created new markets. Apple with the smartphone, Tesla with electric cars, and Nvidia with artificial intelligence. But the growth that they went through was very dramatic and is already pushing the limits of what modern company valuations can be. It's very unlikely that we're going to see that repeat itself in the future. And in fact, you can already see the chart starting to level off. In fact, most of the big spikes you see on this chart in the past are often around transformational times in the markets where companies are innovating in new spaces, like Microsoft with the personal PC in the early 2000s. All right, let's go back to the chart that we started this all with. So the Fed sure thinks a recession is coming, but let's remember that when the Fed started raising interest rates, they very bluntly said that fighting inflation was more important than keeping the economy out of a recession. To then turn around and predict that a recession was coming, it's kind of like you driving a car and predicting that there was going to be an accident down the road and then running every red light. Predicting something that you're actively creating isn't much of a prediction. But the Fed's been running red lights for like a year and a half. And as the article said, if we're in a recession, it's sure a strange one. This is a chart of TSA checkpoint travelers, which is a good indicator of how many people are flying. You can see we are back to pre-pandemic levels. And this is during the time when business travel, which is a major percentage of all US flyers, is still way down because so many businesses have converted to remote meetings, which means a lot of these travelers are just people going on vacation, which typically does very, very poorly during a recession. Now, this is only one indicator, but we could also look at how well the job market has held up, and we are eventually going to look at the housing market. So how did we escape this recession? Well, one reason we may have dodged it is because the Fed told us that they were going to cause it. And when someone even as unreliable as the Fed tells you something's going to happen, you get ready for it. This is one of the simplest and yet most profound charts of the article. It's simply a survey of what people think the Fed was going to do after the July meeting. Were they going to keep rates the same on the left or raise them 0.25% on the right? 92% of people were right and predicted that they were going to raise rates 0.25%. One profound thing about this chart is that there's only 2 choices on it. They didn't give people the option of raising it 0.5% or even lowering it 0.25%. Because the plan that the Fed was following was very clear, and everyone understood the Fed was really just deciding between keeping them the same and raising them 0.25%. That's a level of clarity that we rarely see from the Fed. And we've been seeing it for like a year and a half. The Fed told us very clearly they were going to raise interest rates aggressively at the risk of driving the economy into a recession, and that their long-term goal was to drive inflation below 3% and eventually get the interest rates back below 2%. They then followed through on the plan, and as clearly as they could, they communicated it with us. It's not that the Fed didn't communicate well before, it's that they weren't following such a well laid out plan. It's also important to understand that Jerome Powell, the chairman of the Fed, sees an unprecedented level of support. He was appointed under Trump and reappointed under Biden. And as recently as 2022, his confirmation hearing was a vote of 80-19. In such a political world, to see someone with such unprecedented support from both sides of the aisles truly is rare. One of the reasons we may not currently be in the recession that the Fed predicted they may drive us into is that they so clearly laid out their plan and did a great job of communicating it while they were doing it. People listened and prepared for the recession that may or may not come. This chart is the result of those Fed actions trying to get inflation to come down. Now, we know a little bit more since this chart was published, and it's come down even more, but it does seem to be getting sticky or kind of leveling out around 3.5%. Now, 3.5% inflation certainly isn't what it has been for the last 10 years, but by no means would anyone really consider high. So whether the Fed's action caused inflation to come back down, I will leave up to the economists to argue about, but inflation has come down. It is important to understand, though, that as inflation comes down, that's just the growth rate at which prices will increase in the future. It does not mean that prices will at some point go back to what they were, right? For inflation to come down to 2% just means it's only going to continue to grow at 2%, not that it's going to start coming back to where we were, say, in 2018. For that to happen would require deflation, which has its own problems and would be the topic of an entirely different video. Before we go on to the last topic, the housing market, let's look at this one, which is the Global Supply Chain Pressure Index. This is really just showing that the supply chain disruptions that came out of COVID truly were unprecedented. There's nothing like it in the previous 25 years. You pile on top of that the war in Ukraine, the US-China trade relation degradation, and China's own economic problems at home. And it really has created a kind of special 3 or 4 years that has kind of uprooted this globalization trend that we've seen. And now we're seeing what many people call deglobalization, where large companies really are trying to refocus on their supply chains and try and understand what is important to have globalized and what is important to keep closer to home. The big concern about this chart for me is actually the fact that even though they show this going back to 1998, it turns out the index was only created in January of 2022. So when you create an index to measure global supply chain pressure in a global supply chain pressure event, I'm a little worried that you start trying to measure what you want to see. So it's not that I think the chart is misleading. I just want you to understand that creating an index in 2022 and measuring it back to 1998 is very different than creating an index in 1998 and seeing how the future turns out. Again, I don't think it's misleading. Just take it with a grain of salt. All right, on to the final topic, the housing market. There are 3 charts to cover. This is the first of them. It shows that U.S. large home builder stocks are way up, implying that the housing market is still very healthy. However, I have a very hard time correlating high stock prices with the fact that the housing market is doing fine. In fact, if we look back in 2008 during the global financial crisis where the housing market fell apart, just before its stock prices were way up. So again, I don't think the chart's misleading. I would just not put too much weight with this one either. Here's a chart of the change in home prices year over year. So that means that anything above this 0 line is implying that home prices are going up during that time, and anything below it implies that home prices are dropping during that time. You can see that we've gone through this big spike in the last couple of years where the values of homes have dramatically increased. And even though you do see this dramatic line plunging down right now, we have to understand that's still all above 0, which means even while it's coming down like this, home values are still going up. Now, this chart ends around February of this year, and we know the punchline of what has occurred over the last few months. And unlike back in 2008, where it just continued to plunge and went very, very negative, this has started to level off just barely negative, meaning home prices have started to come down just a little bit. Now, one of the major concerns and problems that the younger generations are voicing, or really anyone who's trying to get into a house, is that home prices are incredibly expensive and just unaffordable right now. So, in my opinion, to be perfectly honest, if we see a large number of years where home prices are slowly coming down, that is not necessarily a disaster for many of Americans who are trying to get into the housing market. This is the final chart. If you're still with me, thank you. Please consider subscribing for similar content. The story around the housing market has been hard to escape. Interest rates have gone up dramatically. Mortgage rates have almost doubled over the last year and a half, making buying a new home even more expensive. So why has the housing market stayed so consistent with prices staying high? The boring answer, which doesn't sell very many newspapers or make for very good YouTube videos, is that the supply simply isn't there to meet the demand. Even though demand is way down, few people are selling their houses because they don't want to have to go buy in a new interest rate, and we simply aren't building them fast enough for the demand. This chart was the most surprising to me, which is the best answer I've seen as to why that is. It shows the number of new house starts over the decades going back to 1900. And you can see that since World War II, we've been building houses at a rate of about 20 to 25 million a decade. Now, house starts are easy to measure because they're all permitted. And during this time period, US population was rising dramatically, and it somewhat has leveled off recently. But after the 2008 global financial crisis, from 2010 to 2020, we built only 5.8 million new homes. That's the same rate that we did in 1900 when the US population was 73 million compared to the 330 million that it is now. Now, I can believe that maybe we overshot and our population is starting to level out, but I have a hard time believing that this was keeping up with the demand. And it's probably going to persist for at least the next couple of years as well. I'm involved with the HOA where my home is, and the one thing I hear from all new lot owners is they can't get a builder. They're all 2 to 3 years out. And when I talk to the builders, the story is the same. They simply cannot hire enough people to take on all the work that they could be doing if the labor market wasn't so tight. Now, what's going to happen to the housing market over the next few years? I'm not going to try and predict that, but this story around supply does seem to be true. You probably think I'm trying to convince you that a recession is not coming. But after the supply chain disruptions of COVID and the record-setting interest rate hikes and all the inflation, even I will probably tell you that over the next couple of years, it wouldn't shock me if we go through some type of an economic downturn. But we haven't been through a normal recession in a while. Now, no recessions are normal, but the COVID recession we effectively caused in the 2008 global financial crisis was a major recession, really ranking in the top 2 of all US economic downturns. To get to a regular recession, you really have to go back to the early 2000s, which is almost 20 years ago. Now, it may be the case that in the future, we don't go through normal recessions and every recession we go through is bad like 2008, but that's pretty speculative. Most of these charts, in my opinion, just show that the economy's average. But average is really boring and it doesn't sell a lot of news. And if you're more likely to believe pessimistic news than you are to believe about optimistic news, then the media is going to feed you a bunch of pessimistic news about the economy. And you have to remember that we're terrible at predicting recessions. So you put this all together, and in my opinion, it makes being overly pessimistic about the economy just as damaging as being overly optimistic about the economy. And it's very important when dealing with your own finances that you are in touch with your own biases around media and the news and what they're telling you and what you're consuming. I hope this has been helpful. Thank you.